Hi there everyone, Rob McGregor here and welcome to our August-September edition of OnTrack. That is news up to the date of recording this, which is actually the 29th of September, and financial figures, end of month figures to the end of August. Lots to go through. I hope you're all doing well. It's a crazy world, feeling lots of thoughts for our friends and clients in New South Wales and Victoria. It's been a tough winter, and hopefully there's some end in sight for you guys. As always, this video is for clients of McGregor Wealth Management, and especially those that operate the care philosophy and care portfolios as part of our service. Anyone else, feel free to tune in, but please get advice before acting on anything we talk about. Today I'm going to talk about some of the latest economic news, put it into context with what's happening in the market. We've just had a little correction, which was quite healthy. Update on the key markets, talk a bit about the property markets as well. Look at the returns, which continue to be rock solid. I'm going to compare what's happening in the UK with COVID and getting out of lockdowns and into freedoms with what's happening in Australia to try and understand what we can expect in the next 6 to 12 months. It's a way of looking ahead. I'm going to revisit COVID deaths both in the UK and Australia and put it into perspective of life and deaths in a normal world. And I find perspective very hard to get from the mainstream media. They're so concerned with getting our attention, scaring us, and the same goes for politicians at the moment. So it's very hard to get accurate, good, objective news. So I'll attempt to put some perspective around some of that. We'll talk a bit about the economic outlook, which is reasonably good. And property markets still running strong in most parts of Australia. Slight exception on units in a city, particularly Melbourne, Sydney, and they're not terrible, but they're just not growing like any lifestyle property. Everyone's gone tree change, sea change, and back out to the burbs where people want some space. And we'll talk about all that. And as always, put it all in perspective to help you have confidence in your long-term investment strategy. So firstly, some of the numbers on the right, no real change. Interest rates are still incredibly low. 10-year government bond yields picked up a little bit as inflation numbers have ticked up in the last couple of months. The massive debate is around whether that inflation is transitory, to use the word of the month from all the Federal Reserves, or whether it's a sign of a trend to come. No one can tell us at this stage. All the experts, the OECD, the world, all the central banks around the world, that's the RBA, the Feds, all say it's transitory. There are some skeptics. I'm set somewhere in between, and that we need to be cautious. There's definitely some inflation emerging. We'll talk a bit about that. What that means is interest rates are still incredibly low. And we've seen talk from Josh Frydenberg that he wants to start tackling some of the lending in the property market, and we may see some restrictions on things like investment loans, interest-only loans, that make it a bit harder for the banks just to slow down that rush into property. Interest rates are incredibly low. The lowest on the sites, when I have a quick troll at them at the moment, is a 1.69% special. Quite crazy. The average, high twos. It's hard to determine averages. You can get lower than that, but the average rate most people are sitting on somewhere around that range. And for those with term deposits, it's a pretty sad state of affairs at around 0.3%. You might get a special at 0.35, and if you go into one of the bank's online saver accounts and you deposit regular amounts into there and limit your withdrawals, you might push it up to 1%. But fascinating. A bit of data here on the two graphs that I've picked out for this month. The top one just shows the annual number of dwelling sales. That's house and units. And this goes back to August 01, and we're just hitting highs that we haven't actually seen since the turn of the century. So that's just the quantity. So houses are selling like hotcakes. It's a vibrant market. A lot of people are taking the time to upgrade or downgrade or plan for retirement or get into their first homes, but there's lots of action, partly driven by that low interest rates. On the economic activity, this is a chart we sourced from AMP, which is an economic activity tracker. So it shows where economic activity is heading. And this goes back to the start of COVID. We saw it drop off a cliff around the world for the US, Australia, and Europe, and then proceeded to recover Australia set the benchmark for recovery, partly due to luck of our low COVID exposure initially. The US followed. Europe was in the doldrums as they had their first, their really bad COVID season in first wave. But look what's happened in the last little while. Australian economic activity has plummeted in the last few months, and that's driven by lockdown in our two biggest states, which account for a majority of our population. So it's hurting economic activity, and meanwhile in Europe, where they're getting back to normal, their economic activity is ticking up, and the US just trudging away in between. Now, most of the experts expect Australia's economic activity to march back up, and we'll watch in the next few months as we come out of lockdown, which brings me to the news highlights. And I really think we've got a fascinating and interesting and challenging 6 months ahead in terms of life in Australia as the different states forge different paths out of COVID and have got different restrictions. We may see New South Wales coming out into relative freedoms very soon, followed by Victoria. But we might see states like Western Australia and Queensland take a bit longer, and we might have the crazy situation where people in New South Wales might be able to fly to New York and London and Europe, but not to Perth or Brisbane. And it's going to be fascinating. I think 6 months and we're on the other side of it for all of it, but we're hearing talk about, we're going to need vaccination rates at 90%. I'm going to put some of these numbers in perspective as part of today's brief as well. We saw a brief correction in the share market. I'll talk through that, but it was well overdue. We'd had 9 months in a row of up, which is kind of up there in record territory. So the market needs a breather every now and then. It's only gone back a couple of months, so quite healthy. And we think that puts it back a bit closer to fair value. We saw the property company Evergrande fail in China. So lots of people try and draw parallels about what that means. We saw that flow into potentially falling iron ore prices, which meant BHP, Rio Tinto, Fortescue, and the iron ore providers in Australia. So their share prices drop. Lots of speculation about what that means, but effectively, I don't think it's going to be one of these big catalysts that causes a massive flow on. And no doubt the people of China, the billions over there, are not going to stop building houses and apartments completely, although always hard to tell on economic news out of China. So we're seeing vaccination rates climbing, but is it quick enough? And will we see it taper off as we get around that 70, 80%? I'll share the UK numbers shortly, so you can see what happens at the end of that. I think as we speak, New South Wales is hitting its sort of 70% first vaccination, soon to be 80%, and hopefully they'll see restrictions eased, which will pave the way for the rest of us. I think it's universally accepted that the only way out of this, both economically and lifestyle-wise, is for vaccinations and then to open up. There are still some people that are very hesitant about that, and that's driving popularity of leaders that are happy to err on the cautious side, but that's coming at an incredible economic cost, an incredible mental health cost, amongst other things. And for states like Queensland and Western Australia, at some point they have to let the virus in. You can't keep this out forever. That goes for New Zealand as well. And the combination of vaccinations and then letting it go carefully is the obvious way out. So we've seen that strong recovery in Europe and US, as I said, the highest property numbers, and we've talked about that. So let's dive into some numbers. So to the end of August, you can see the 1 year performances here for the different risk profiles are extremely healthy, with balanced investors around the 18% and growth and high growth up in the mid to high 20s. Well and truly in excess of our target. Keep in mind, the year before was pretty ordinary. So when you look at the 3-year return at the moment and the 5-year return, they're pretty much right in line with our long-term averages, slightly ahead, given inflation is fairly low over the last 5 years. So good results. The care portfolios aren't too far away from coming up to their 7-year return. So we'll add those numbers as we get past that. And that's numbers that are accountable. We've obviously been running the care process for nearly 20 years, but all differently. And we moved towards those managed portfolios about 7 years ago, which have seen consistency and results that we're extremely happy with. I've put another portfolio down here. It's one we launched just over a year ago. It was designed for our kids. So when I say our kids, the GPS Investment Committee's kids, who are all in their 20s. And we said, knowing what we know now, after collectively 150 years or something in markets, how would we be suggesting people in their 20s invest their super in particular? So we designed an ultra high growth portfolio, and it's in things like India, like artificial intelligence, robotics, global healthcare, global small companies. So areas that we know will have a genuine edge over the long run, but may have short-term volatility. And for the 20-somethings, the 30-somethings, that volatility is fine because they're building their super and can't touch till they're 60. A funny byproduct on the way that for some of our clients that have got more capital than they need, we're finding that portfolio is attractive for a small portion of that. That is the bit that is effectively an estate planning portfolio that will go to their kids. So where appropriate, we'll talk to some of you about that one, but it's had spectacular returns now over the last year. But we'll have volatility as always. As we run through the cycle, and just to keep that context of the fact that markets cycle, boom, bust, and the wall of worry. And we each month rate the markets as either somewhere in that FOMO, fear, wall of worry, expensive, fair, cheap. And most of the time the market is in the wall of worry as it is at the moment. It's pretty much back to fair value. It's a touch above fair value at the moment. And that's recognize that we have this pendulum of psychology that is always swinging, and at market extremes it swings all the way to FOMO, or the fear of missing out, which is the greed part of the cycle. There's a question about whether we're starting to dip into that in the property area, and I'll touch on that a bit later. And those booms, the FOMO is always followed by a bust, and this page shows the top 9 of them since 1900, and they're all above 25%. So we make no attempt to predict short-term corrections like the one we just had, which was about 5%. They're normal, and pretty much every year we'll see a 5 to 10% correction somewhere in the year. It's always unpredictable. Those that are trying to trade at that level will invariably get washed around and lose money both in transaction costs and getting it wrong. You've always got to make 2 perfect decisions. So our focus is on trying to make sure we're ready for when we hit one of the boom cycles, which we're certainly not in any case at the moment. Certainly not in Australia. I'll talk through some of the US numbers, and they're a little bit more expensive, but with strong profit results and low interest rates, highly justified for now. So let's have a look at COVID case. I'm going to go through the UK, then I'm going to go through Australia. So on the left-hand top here is the waves we've had of COVID cases since it got into England back in March of last year. So started off what we thought was high, but was actually pretty low. We had that incredible first wave for the winter, and that's, keep in mind, that Northern European winter in England is in January during our summer, and that was a pretty ordinary winter for England last year. Lots of cases, the peak 60,000 cases a day, and at the peak of that there was about 1,000 to 1,100 deaths per day at that period. So that's a lot of deaths, but let's put numbers in context, because when you focus on a number in isolation, it doesn't give you any context, it doesn't give you any perspective. So how many people die in the UK each year? So this chart on the bottom left shows that, and that the number of people that died in 2020 was about 608,000. And you can see that the mortality rate that's standardized on the right here has been pretty constant at about 1,000 out of 100,000 people for the last 15 years or so. It was edging lower, it's got a little bit higher, but it's still lower than, say, 14 years ago. So that's 1% of the population that die every year. So when we're looking now at 122 people dying per day, and I absolutely want to acknowledge that every death is a massive emotional cost to the families and the people around that person. So I'm not diminishing any individual death, but just saying it is one of the certainties of life, unfortunately. So 122 people a day equals 44,000 a year. So if COVID deaths remained at that level, that would be roughly 7% of all deaths. Now, I found a good article that talked about the cause of deaths in the UK, and I've got one for Australia in a minute. So at the peak of back in January, when the deaths were high, COVID was actually responsible for 37% of deaths in that month. So it was huge. It crept back at the start of July to about 2%, and by my rough calculations, and I'm not a data scientist or a health expert, around that 5 to 7% at the moment. But then you're up there with all the usual suspects that people die in, which is strokes, dementia, lung cancer, heart disease, respiratory disease, etc. So there's some UK numbers. I'll come back and forward to this as I go through the Australian numbers, but have a look too at the vaccination rate. So in the UK, that's the total UK, there is 67.1% of the population fully vaccinated. So in England, that's about 67%, Scotland a bit higher, Wales a bit higher, Ireland a bit lower. So be very careful when you're hearing our state leaders start talking about 90%. I'm not sure we're going to get to 90%. I'm not sure we need to get to 90%. And if you cast your mind back to the rhetoric and the talk, that the overwhelming point at the start of COVID was to not overwhelm the hospital system and to flatten the curve. So, yeah, and that's what we're seeing at the moment. We are going into a risky stage in the Northern Hemisphere where they will go into winter again. So it will be interesting to see whether the curve stays flattened or whether it goes up. So that will give us an indicator of what we've got to look forward to. And we've pretty much been 6 months behind on anything just on a season basis. So let's have a look at it in Australia. And keep in mind, we're talking about 60,000 cases at the peak. Australia's at 1,600 cases. Now, England's bigger than Australia. It's not that much bigger. It's about 4 times bigger. And you can see the number of deaths in Australia, about 161,000. It's ironic, less people died in Australia in 2020 than in 2019. And then on this chart down the bottom, we've got the cause of death leading, starting at the top with things like heart disease, dementia, Alzheimer, cardiovascular diseases, cancers, etc. Now, a couple of things to note here. One is the quantities. So, every year there's 17,000 people dying of heart disease. So our current COVID deaths are averaging about 11 a day. So let's say we peaked generously at 20 a day. 20 a day would be 700 a year. That would not rank on this top list. So at the moment, Australia is not anywhere near that. But have a look at also the median aged death. Now, median's the age in the middle. So it's not an average, but it's like an average. Half of death from these causes occurs above that age and half below. So 84, 89, 86, 73 for lung cancer. The lowest ones as we go down is intentional self-harm, where the average age is 44, reflecting the fact that that tends to be one of the bigger causes of death amongst young people. I'd love to see some statistics around that. Keep in mind, this is only 2018. But also note that the flu here is about 2,500 to 3,000 per year. And there'll also be somewhere in here, sort of lung stuff as well, chronic lower respiratory diseases, 7,800. That's pneumonia predominantly. Now, a lot of COVID deaths, and keep in mind, when they record a COVID death, it's a death with COVID. It's not a death from COVID. So they'll record a COVID death when someone dies with COVID, even if they had other, as they call it, comorbidities, which are all these things. So, and let's have a look now at the age of the deaths in Australia. So this is all the deaths in Australia up to the 26th of September. And look at the tilt. The majority of them quite clearly in the 70 plus age group. And I know that's always been a concern for people in that age group, and particularly aged care system and anyone with any of those other comorbidities. But this is quite clearly, and these are COVID deaths. Now, in the States and in the UK, most of the people in these age groups that are dying with COVID are also dying with 2 to 4 other comorbidities. So hard to say whether COVID caused it. And at the moment in Australia, we have 0 flu. So I don't say this to diminish COVID. It's been a serious world event, but I say it to put into perspective. We are inflicting incredible economic damage to chase down something that is actually doing less harm than many other things that people routinely die at of the same age. Now, that means nothing to the people in power. I just want to put it in perspective and say, I think we come out of this in the way that Europe is and England is, and hopefully all the states can get on board the same path. I suspect that takes 6 months, and then the fingers crossed bit at the moment is what happens in the UK in the northern winter. We will watch with interest. But economically, it doesn't worry me too much because we've shown during this period that we continue to spend, and most of us continue to earn well. And then the areas where there's been lack of earnings, governments have pumped money into the system. I'll talk more about that. Just a reminder, as always, that most investors, not you guys, mess up their investing by these initials, focusing, letting the media guide you, emotions, etc. And when I created this concept 10 years ago, I could not even imagine that we would have an issue like COVID that would be such a short-term, single-issue focus that put this under so much intense microscope. And it's quite amazing that during this period, we've had such a good run in property and shares. I won't go through the care stuff there. I want to get into some data from our friends at Realm. So Realm, one of our key managers in the care portfolios, and some of the smartest people I've ever met in fixed income. It's been a pleasure to have had them as part of our process. So they presented to our investment committee a couple of days ago. So I've borrowed some of their slides, so credit to them. So they monitor what's going in fixed income markets and inflation and credit, that's corporate credit, very closely. So we see once again this world momentum where anything above zero here is above average trend growth, so the zero line there, and anything below it is below average. So we came out of the GFC and bounced back up with growth. We've been sluggish. We just got back in 2017 to above trend growth. It was starting to slow down a bit back to trend, and then COVID hit. We dropped right out, but the momentum is huge. It's an unprecedented recovery in economic activity. We will see, and this is for the globe. I'll show you Australian numbers in a minute. There's been some worry about US debts, and you'll hear debate again about the US debt ceiling, which is so partisan and political in the States. It's almost a joke. But yeah, the US federal debt is about 14% of their GDP at the moment, so that's very, very high. But the OECD and other credible experts are forecasting that gets back to normal in about 2023, or back to a normal range. Still high at 6%, but not crazy high. You've seen, the bottom right here is the Federal Reserve pumping money, and the European Central Bank pumping money into the system. So literally unprecedented. Never before has so much money pumped into the system. And these are trillions. So that's $16 trillion is gone into the system that didn't exist. So that finds its way into share markets, property prices, and other prices. And we've seen rates at near zero. So that's both interbank rates and short-term money market rates at pretty much zero. Similar in Australia, that momentum out of COVID, just incredibly strong. Australia's federal budget deficit, as I talked about in the budget episode, was high 10s. It's coming back to the 6s. Not quite as strong a rebound as the US, but gets back to basically the same area. The Reserve Bank also injected 360 billion and counting at the moment. They're still doing it, but they're about to taper into the system, which has led to us being supported. What you see here, and the key point I took out of our briefing from Realm this month, was that there's no pressure on household debts, on household budgets, due to extremely low interest rates on mortgages and high savings. So those without mortgages have saved, those with mortgages have got record low interest rates. So as Realm put it, households have dry powder. So if we get a situation next year where we can travel, where we can do things, you may find some of that powder gets deployed, and we potentially have a very strong global economy next year if things go really well, which is one of the probable cases. But as I said, on the other end, watch the Northern Hemisphere. If COVID deaths rear their ugly head again in any great momentum, then that will probably be a sign that we've still got a little bit of a way to go. But overall, pretty healthy. And Realm track the forecast GDP, CPI, and employment amongst a number of figures going forward. And you'll see, and this is their read. They pull together all the experts. That's the OECD, that's the reserve banks around the world, etc. And these experts have us returning back to kind of normal GDP growth, normal inflation within the next 2 years. There's a whole lot of things that can happen to push that higher or lower, by the way. So never before has there been so much doubt about whether we get higher than that, lower than that. And the key fact there is will interest rates and inflation stay low? And that's the thing that certainly bond markets will be watching, and that will affect markets over time. The Reserve Bank has said they don't see any interest rate increases till 2024. Federal Reserve 2023-24. I asked a few other analysts that present to us whether they believe that, and there's a bit of skepticism. And yeah, if we do see massive spending take off and inflation continue, then we may see interest rates go up early. But no one wants that up, given the level of high government debt and mortgages. So in shares for, this is the month of September, and you'll notice in the top chart, I've shown where the end of August finished. So the returns were positive to August. The annual returns there are all for August, but we've seen that little correction since. Not crazy, as I said, only going back to about June, July figures, and the 5-year chart there showing quite clearly the COVID V, and yeah, the quickest recovery in history. And you can see there the top 10 companies that sit in the ASX 200 and sit in your portfolio as part of that. And you can also see their 1-year returns. So ranging from a low of 6 for CSL, which is a mighty company that's returned very well in the long run, but had a quite a year last year, to the top return in our top 10, which is ANZ Bank and CBA, which have had massive recoveries, and BHP, etc., doing well and paying dividends. International, US markets up, also had the correction, nothing too serious and very healthy given the run we had from May. And you can see that here, there's nothing but up. So a 5 to 10% correction was always on the cards. Once again, we don't attempt to trade those because you can't predict them. And you'll see here the different returns in the US from Alphabet, which is Google, up 100%. Same with Tesla, Apple 36%. So these companies have benefited massively from COVID. They've seen their profits increase, but as interest rates have been lower, people have always been willing to pay higher prices for them as well. US small caps, less familiar names there, but you'll see things like Macy's. It's interesting, the top of the US small caps, 479 billion US, is actually bigger than Telstra in Australia, which is the bottom of our top 10. So when we say mid caps, small caps in the US, they would be large caps in Australia, and it's certainly the heart of global capitalism is that US small cap space, and you'll see that in its 10-year return there at 18%. We're a bit cautious on this. We think this is at the fair to expensive end, but there's been massive innovation here. We've got massive profits growing as well, so we're reasonably comfortable, but watching closely. Same with the global leaders, which also represents that the companies I talked about there, Apple, etc., a 10-year return of 15%, 5-year of 17%. So when we've seen that kind of activity in the medium term, we know that's slightly above average. So we watch with caution, and we may take some profits if appropriate in those sectors. Emerging markets have been a bit more beaten up. They're a bit more involved in that correction, obviously, with China and that property company failure I talked about. So they had a negative month in August that flowed on to the rest of the world, but still solid over 5 years at 10%. And certainly we expect emerging markets to be an area that will grow above average. What you'll probably find is in the next 5 years, as people in the US look at their markets and think they're a bit expensive, and as the world recovers, they may start investing more so in emerging markets, which goes well for them going forward. Gold, a critical part of the portfolio. It's an insurance policy, pretty boring, up for the month, but down again a little bit since, and it's actually gone backwards for the year, about 10%. We don't mind when gold goes backwards. I don't like it when anything goes backwards, but when gold goes backwards, it usually means everything else is charging, and gold's in there as that insurance when things aren't going so well. In the last 10 years, gold has averaged 4.9%, which is better than cash, I should point out. So property, this is the percentages around Australia, and just a sea of green with a slight adjustment in Darwin, which had a crazy month the month before. So you'll see sort of that change year on year. Sydney up 26%, Melbourne 15%, Brisbane, including the Gold Coast, up 21%, Adelaide 20%. So 20s everywhere. The top performing suburbs in Australia are sitting at 50%, and that includes places like Noosa, and the Sunshine Coast and other tree change and hill change places. And here's some of the stats that sit under the property, and you'll see, and tell a bit more on this story. So the top left chart here shows the median value of capital city houses versus capital city units. And you can see that gap has widened to the biggest it's been in the last 14 years. So houses have gone up strongly, but units haven't. The big question is, will houses come back, or will units go up in a catch-up? And we'll see a bit of both there, I suspect. You'll see the growth in all the indexes through this panic. So starting with pre-COVID back in January, and if all the prices were adjusted to 100, you can see how each state has come out of this. Sydney actually, once again, right up the top there, 24%, closely followed by Brisbane, Adelaide, and Perth. Now, not as much as people are talking about. So that Perth market's still one where we're fairly comfortable in as investing, which I've talked about in previous months. But look at rents. If the people that are renters at the moment, the rents have gone up between, excluding Melbourne, between 8% and 23% in Darwin, 15% in Perth. Often rents going up like this are a precursor for prices to go up, particularly where you see big numbers like Perth and Darwin there. And the top right chart I'll finish at shows the number of listings in the light blue and the number of houses on the market. So we've actually got a drop. There's actually a shortage of houses on the market, and even though we've had record number of sales. So this is causing the market to be very strong. Remember, property prices determined largely by supply and demand. So when supply is low and demand is high, the sort of price action we're seeing is completely normal. So that results in this from our friends from Heron Todd White that shows everything's going up. There's nothing on the right side, no declining markets in the housing market, and everything's in that rising market. Called a few at the peak, places like Canberra and a bit of regional New South Wales, but most places, including the Sunshine Coast, including Sydney, including Brisbane, including Perth, are in a rising market. So very interesting. As always, be careful. If you're buying or selling, happy to talk about these things. We take a great interest in the property market, one, because it forms a part of most people's wealth, two, because the property market flows on to the share market and vice versa. When people's houses are going up, they feel more confident and they'll often spend more, which can lead to higher than average economic growth. But conversely, when the music stops, it can lead to slowdown. So we watch that. One of the reasons we watch that very carefully. So wrapping up, just reinforcing our process that we have a sincere belief that all investing is best done as part of a real financial plan, which is based on you, your individual circumstances, your goals, and what's important to you. We take a long-term view, but we do watch everything closely on a short-term basis. And the best protection, is around diversification, having the right asset allocation and enough liquidity in the portfolios. We use low-cost index for most growth markets, but definitely not so much in the fixed income space at the moment, which is the trickiest market, even though it has the lowest returns. And to protect against short-term volatility, we use the reserves for our retired clients and dollar cost averaging for those still growing their wealth. We rebalance those portfolios regularly at multiple levels, which adds value to the returns. And as always, there's only 3 ways to lose money. Don't do them. 1, panic and sell. 2, happy to sell. 3, not properly diversified. I hope when we're recording this next time, our friends in Sydney are on the move and Victoria not too far out of it. And then we're going to have an interesting Christmas. We may not be able to visit each other in different states still. We will see. I suspect that will be the case, but hopefully by March, hopefully we're having Easter all around Australia without any restrictions. But time will tell. It's been a fool's errand to try and predict anything during this crisis. But we do try and gaze ahead just to, one, give you the information to help you put everything in context. Thank you as always for listening. Hope you have a great month and look forward to talking to you soon. Rob McGregor signing out.